Hello everyone, welcome to Tekpon SaaS Roundtable. This is our first roundtable and we'll be talking about fundraising and the winning strategies for capital acquisition in 2023. Firstly, let's introduce our guest. I'll start with Chris. Chris, please tell us more about what Founderpath does.
Yeah, no, thank you so much, everybody. So glad to be here. My name is Chris Saum, and with Founderpath. Founderpath provides non-dilutive capital to B2B SaaS founders all over the US and global. We help turn their MRR contracts into upfront cash. To date, we've deployed about 120 million to over 300 founders. Really proud of that. We make it super easy for them to sign up, link their accounts, and get cash. So that's who we are. And then my background, kind of unique journey to where I am today. I'm a previous founder, spent the last 5 years on the VC side. So I have that perspective to add to the group as well. And then obviously the Founderpath perspective, the non-dilutive versus equity perspective. So looking forward to getting into it with everybody else. Thank you.
That's awesome. Thank you for joining. Jonny, can you please continue?
Sure. Jonny Price, VP of Fundraising at Wefunder. Wefunder is a platform that allows founders to raise capital from their customers and community, as well as VCs and angels. We call it a community round. You've heard of an angel round or friends and family rounds. This is where you can let your customers, community, unaccredited investors, as well as accredited investors invest. You can raise up to $5 million through a relatively new law in the US called regulation crowdfunding. Happy to tell you guys a little bit more about over the next hour.
Thank you. Thomas, I think you're next.
Hey everyone, I'm Thomas Smale. I'm the CEO of FE International. We are a technology-focused investment bank, so we work with people who want to acquire businesses outright, and we'll often help them look for funding or raise funding or find more money on top of what they already have. We work with people who own businesses who might want to exit them in future, and often that involves raising capital now. And selling in future. Sometimes it means raising capital through an outright acquisition either of some or part of their business. And over the years, we've helped close over 1,200 deals.
Cenk, please tell us more about yourself.
Hi, this is Cenk from Tukel Accounting. Actually, we work with all those startups and entrepreneurs before they go to the Chris, to Jonny, to Thomas to ask for money, for investment and funding. We act like a one-stop shop for all the startups and entrepreneurs, helping with their books, accounting, taxes, cash flow, advisory, HR, payroll, and even we partner with our third-party legal teams to make sure everything is in order and keeping all the confidence, all the confidentiality between client and us. We make sure they get ready, manage the financials properly, and get the funds that they require, either from the lending institutions or from the investors.
That's a unique perspective, so I really appreciate you joining in. Alex?
So guys, I'm a serial entrepreneur. I raise multiple times from VCs, from angel investors, not from community like Wefunder, but I want to learn more about it.
Okay. Horst, I'll let you present yourself now.
Hi, I'm Horst. Several hats. One hat, also early stage founder again, I think company number 5. So I'm familiar with getting funding. Second hand is I'm also an entrepreneurs organization member, strategic partnerships. So in that way, I'm also dealing with money and partnerships and the current market situation. And third, I'm also familiar with Tekpon.
Okay.
So I'm happy to maybe learn some new things. And I would also say, Thomas, we have already met. Founderpath and more Nathan I normally have met, but a lot of the faces here and names are already quite familiar.
Okay, thank you. And Sebastian, your last, please tell us more about yourself and your startup.
Hey everyone, nice to meet you. Sebastian, founder of Digitail. We're a VC-backed startup, raised 14 million to date. We're a verticalized SaaS business operating in the pet care, so we're building the operating system for animal hospitals, and on top of that, we're building for the entire ecosystem for pet care.
My first question would be to you. Why did you choose to raise 14 million? You recently raised 11 million Series A. Please tell us more about it.
Well, long story. So I think we need to go back to 2018. That's when we started. And our first year, we bootstrapped all our way to having the first 50 clients. But the thing is that, one, we wanted to grow globally. So we started off in Romania and we wanted to grow globally. And for that, we needed more funds to accelerate. Because again, selling in the US, selling in other countries where you need people, you need to do things where, again, funds were constrained. And then as we were growing, we saw an opportunity to be one of the winners of the market. So when we looked at the pet care market in the US and other countries, we saw that for most of the time it was a duopoly, which means that you'll have one or two players that will win the market. But to be that player, you need to be one of the first that gets to 20+% market share. So it was a race to get to that position in the market. And that's one extra reason why we went down the VC path.
Thank you for explaining. Alex, I know you are raising right now. Please tell us what your strategy is.
Yeah, I raised multiple times, so I use only friends, connections that I already have. So I am not doing something public or talking with VCs that pitch us, only raising from strategic angels. And my advice to founders is they must raise from people that can really help them. If they are not at Series A yet. If they are seed, pre-seed, they must raise from people that can put something on the table more than capital.
Awesome. Can I add something on what Alex was saying? Because I think it's maybe important to, so as we were starting, so again, bootstrapped, and then we raised our first pre-seed round, which was more an angel type of round, which is exactly what Alex was saying of getting people that have experience in the space that helped us start thinking globally, avoiding mistakes, how to set up a team. And that was the stage they were investing at was they believed in the founder market fit. So they believed that we will crack something in that market. So that was their bet there. Then with the seed round, the investors that came in, of course, the 2.5 million was extremely helpful, but the investors themselves were extremely helpful, not only with the network for hiring, but also to understanding different markets. So that was the moment when also we got Gradient VC on board, Partech, by founders, and they're all investors that have experience in so many markets. And they actually helped us lead. They led the conversation internally for us on which is the best market to tackle next. So that was super helpful. And now with Series A, it's not only the money that we get, but also the operational prowess and experience that they help us. So they have great, like Atomic has great operators on anything from sales, people management, coaching, it's like you name it. And all of that is like having super top-notch experienced people that can help us supercharge. So those were extra reasons for going down this path.
Okay, and now I have a question for Horst. I know you are a bootstrap founder. If you are planning to raise in the future, what would be your strategy? You have multiple options. What is the best for you and why?
To be honest, in the moment, I'm a little bit going with Founderpath or revenue-based financing more. Depending on the situation, I would probably more do revenue-based financing kind of, and go on focusing on my product and sales, because actually doing a fundraising round, especially if your executive team is not so big, takes a lot of resources out of your business. So I would potentially bring a VC if I, for example, have to open a new market. For example, in the moment we are primarily pan-Europe, and I want to go to US and would also like to have let's say, in VC with a strong understanding of the US market and partnerships. So I would say, at least for us, probably a VC had to bring more to the table than money. To be really interesting. So a little bit like Alexandru was saying, get smart money or people really bring you forward. Would be also for me a key driver. And maybe also bring you some strategic partnerships. That you say, hey, to get into that field, I need a strategic player. Or maybe access to 2-3 really big accounts, which could make change how we are perceived in the market. But especially from what I observe from the current situation, VC money is not easy to get. Evaluations, at least in comparison, are by far not as good as they were last year. So you would have to do a little bit convincing just to give me money. It has to be definitely more.
Okay. Okay, Chris, you have a happy customer right here. I was curious to know what types of founders choose revenue-based financing.
Yeah. I mean, I'm happy to give that answer, and then also piggyback on what Horst was saying. I mean, I think in your question around, well, should you bootstrap or raise VC funding? I think as the founder, you should ask yourself the question: what type of company do you want to build, and what type of ownership do you want to have? And I do think you should take the market dynamics into account. Like, the market is very tough right now, and so you truly need to have some sort of outlier type of growth or insight or something to really get the attention of VCs. Now, and then obviously the difference between growing a billion-dollar business or being okay hundreds of millions and just having a more profitable slower growth type of business, which is great. And then I think, like, the opportunity, like, is the opportunity truly there? I think so many founders and companies were VC funded over the last decade, that in the last few years, that honestly should not have been VC funded, because the opportunity is not there and the market's not there. And so I think for the majority of businesses and founders out there, bootstrapping is the way to go. And for that small subset of founders who truly want to go after it, for the $10 billion opportunity, who believe that there is that opportunity, then they should look at raising VC. That's just my 2 cents on what makes a good customer for Founderpath. We're really there to help the bootstrappers for B2B SaaS. So we only work with B2B SaaS founders, those that have between 1 million and 5 million in ARR, typically up to 10, and as low as 500K, but typically that 1 to 5 range, who are a little early for traditional venture debt, maybe don't want the rigidity of a personal guarantee or covenants or warrants, maybe want to put off their next VC round for a bit to put themselves in a better position. So we can provide them up to half of their ARR in upfront capital. So if a company's doing 5 million, we can provide them around 2.5. And they pay us back over 2, 3, 4 years, depending on what we call a Founderpath score. It's like a credit score.
That's awesome. You explained it perfectly. Thank you for explaining. And how about you, Jonny? What types of founders choose Wefunder, raising for community?
Yeah, I would say the best fits for Wefunder are companies with large audiences of customers that love them. Like I mentioned earlier, you can raise 5 million. But I think the really best fits for Wefunder, as Sebastian was mentioning, and Alex, like, not all money is equal, right? And so ideally, not all founders are lucky enough to be in that position where they can choose. So for a lot of founders to be able to raise the money with us, and it's an alternative path for raising the capital, and that's quite valuable. But if you have a lot of options, then I think the value out of the community rounds is you're raising 5 million. The average investment on Wefunder is $1,000. So you might have 5,000 people invest $1,000 each. So Substack is a good example of a company that just did this on Wefunder. They had millions of writers and readers on the platform, and they thought it would be really, really cool to let those writers own a piece of Substack. They thought that might make them more loyal to them, might make them more passionate ambassadors for the brand. It was cool how Alex and Sebastian were both talking about angel investors helping add value. For me, that's a dream on Wefunder as well, right? If you have 1,000 investors in your community round, probably the value that each one adds is going to be a lot less than if you're specifically choosing one angel who can add a ton of value in this particular way. But you have 1,000 of them, and so there's 1,000 people that can maybe help share that job description with their network, or can help open a door to an enterprise customer that you're looking to connect with. So that for me is kind of the founders that run a community around, they see value in letting their customers invest and kind of increase their ownership of the company. And then the founders that are going to most easily succeed on Wefunder are ones that have spent years building a community, building an audience of customers that love them. So when you go to those customers and say, hey, do you want to invest in us? Thousands of them say, yes, sign me up. Where do I send the check? And that makes obviously the fundraising part of community rounds as easy as possible as well.
And I guess that's easier for B2C brands.
Yeah, for sure. B2C, I think, is the sweet spot. We've had many successful B2B raises. Probably the the highlight would be Mercury Bank. If any of you guys bank with Mercury, really awesome banking option for startup founders. I don't know if any of you guys invested in the Mercury community round. They probably sent you an email about it. But yeah, B2B companies. So I think at the time they maybe had 25,000 customers. And so they sent one email to those customers, and 24 hours later had $30 million in reservations. And I think they had to pare down they were massively oversubscribed, so they had to say no to a lot of people. But in the end, I think 2,500 customers invested an average of $2,000 each. So it can definitely be very, very valuable for B2B companies as well. But yeah, because of the larger audience size, B2C tends to be the sweet spot.
That's awesome. That's awesome. Thomas, I have a question for you. I know you invested in a lot of companies. From an investment perspective, what are you looking at a company? Do you prefer them to be bootstrapped? Do you prefer them to raise some funding? What can you tell us about?
We usually work on behalf of people who are investing. So we're not necessarily investing our own money. We're helping acquirers or investors find businesses they want to get involved in. So generally speaking, those people do not care if a business has external funding or not. Often you add complexity if there's external funding, which I think is why companies like Founderpath are popular at the moment and becoming more popular, because you don't necessarily have all of the restrictions you might have if you've raised venture capital. If you've raised venture capital, often you have like a minimum amount you can sell your business for or exit for to make it worthwhile. Whereas if you're using revenue-based financing, it doesn't really matter because you just need to pay back that funding amount. There's no restrictions over what you have to do. And obviously, if you're bootstrapped and you have no external capital, then you don't have any restrictions at all when it comes to selling. So from an investment perspective or a buyer perspective, that's more restrictive. But the differentiation is more the fact that the founder in that situation has control. It's not necessarily the fact it hasn't got funding or it has got funding. Hence why I think, like I said, companies like Founderpath are becoming more popular because it gives founders a lot more flexibility than they might have just raising capital. And the same with Wefunder as well. You don't necessarily have all of the restrictions you might have going to like a household name VC who might own 10% of your business, but you can't really do anything because you're at the mercy of whoever they've put on your board or whatever it might be.
Yeah, totally. No board seats on the Wefunder path. Yeah.
Okay, guys, this is a roundtable. It's not a webinar, so it's not about me or ourselves. So please think about the questions for each other. But before that, I have a question for Cenk. From a CFO perspective, what should a founder have in view? Be careful at before raising investment.
Before raising investment, I'll actually have like a 3 advice. Would it be okay, Christian, if I kind of share a few slides? Let's try.
Let's try, yeah.
Let me try. Window. You tell me if it's visible. It is excellent. So lots of founders, startups, entrepreneurs in SaaS industry and many other industries are a bit pessimistic for the right reasons. And if you look at it in 2020-21, the central bank interest rates were like averaging at 2%. But then in 2022, you know, the whole world, the recession talks and all that stuff, the interest rates started to go up, right? And then this is the OECD consumer confidence indicators. 100 is like the average indicator. In 2020-21, most of the countries were above 100, above average confidence rates. And in 2022 onwards, we see the decline. But you see the upwards trend starting in 2023 in confidence indicators for the consumers. That's a good trend. That's a good sign. Not a definite sign, but not a good sign. And then when you check the final result, what does it mean for me as a founder? Well, if you look at it all these years, 2021, these are the number of unicorns each month created, thanks to investments, low cost of money, and as such, it was like average 50 unicorns being created every month until roughly the beginning of 2022. What do we see happening in 2022? The number has gone below 10 per month. It's 80% decline per month in creation of unicorns. So I guess we're all feeling this. All businesses are feeling this happening. The cost of borrowing has increased. Consumer confidence has declined. So my humble point of view of this is follow the economy, where it's going. That will be number one, because the trends will tell you the money gets cheap, the investors start to invest, consumers will start to spend. And even if you're in B2B business, big enterprises will stop cost saving and will start investing. Follow the economy. That's very important. Please do not ignore this. The second thing is prioritize and balance your borrowing versus investors. What I mean is investment. When you want to get an investor, are you investing or are you gambling? So Sebastian nicely mentioned that how he got the investors, and also Horst mentioned that he was gonna go like from a source like Founderpath, a revenue-based funding. Maybe this is the right time to try that path versus going after investors. It's more of the timing where you are as a business and where the economy is. But when you do that, please make sure you're not getting money to gamble. You're making sure you're making it for an investment, right? That's very important. Is it the right time? Do you have a rock solid plan? That is very important, whether you're borrowing, whether you're chasing investors. And the other part is, we all talked about it, targeting for investors. So depending on which stage your business is, do you have an MVP, you just started selling, you're in the game, are you in a high growth pace? Sebastian nicely mentioned that they went after big funds when they wanted to go global. That's what Horst mentioned as well, right? Currently he's in Pan-Europe and he's okay with revenue-based funding, but he wants to go into the States, to US. That's when he might consider a VC. So those are the games. There are different types of investors. There are different types of funding. Make your game plan. Get this there. Make your game plan. That will be a quick summary, Christian.
Thank you so much. It was a fantastic presentation. Now to open a bit the questions and the discussion. I know there are a lot of angel investors here. What are you looking at when you are investing? Alex, I'll let you start first.
Me, as an angel?
Yes.
Currently, I'm focusing on Tekpon, so I'm not an active investor, angel investor. Only if I find, I don't know, a very close friend that is raising, I will help him with, I don't know, 10K, 20K. But I am looking at the founder because I invest pre-seed, kind of. So as a personality, if they are passionate about what he's building and if he really have the power to continue when it's hard, because we all know, guys, it's not easy to run a company. It's not easy at all. It's hard, and not everyone on this planet, 7 billion people, can do it. So I will look like a person that, like me, doesn't matter what and how, he will achieve his goals and will, when it's hard, will continue to run.
Okay.
Can I jump in here, Christian?
Absolutely.
So I made some angel investments. Obviously, I've been on the VC side for the last few years. If you're looking to get into angel investing, I recommend reading Jason Calacanis' book called Angel. It's a really good playbook. Just highly recommend it. I think if you are going to be an angel investor, to do it right, I think you need to set aside a certain allocation of capital. Like, you don't want to be in the situation where you write 1 or 2 checks. You really need to have the portfolio theory and do 10, 20, 30 types of checks. And so making sure that you right size your check amount is super important. The smaller you go, the harder it is to get on the cap table, because most founders don't want to accommodate a bunch of 5K, 10K checks. But if you have a special relationship with that founder, then they can make special allocations. So anyway, I'd recommend looking into that book. And then for me, I'm always looking, for me personally, at the VC fund, we had a mandate, right? Pre-seed B2B SaaS companies, seed B2B SaaS companies outside of Silicon Valley. For the angel investment side, you have the luxury of investing what you like and who you like and things you want to see, built in the world. And I think that's super powerful and exciting. So, but yeah, at the very early stages for angel checks, it comes down to the founder and why they're the best in the world to execute on this exact problem. Yeah.
I'll be a little obnoxious, Christian, here and just kind of preach the Wefunder gospel. But to what Chris was saying there, like 10, 20K checks, 5, 10K checks, like one of the hopes we have for Wefunder is to get more people angel investing. We think like the world will be better when, more than whatever it is, 0.2% of the US population is writing angel checks. And so we're about democratizing angel investing. And if you are just like dipping your toes in the water of angel investing and you're starting out and you've never done this before, like as I think it was Chris was mentioning, like that portfolio diversification approach is like very important and wise, and Wefunder allows you to do that. So the average check size is $1,000, minimum is often $100. One line on the founder's cap table, but you can say you have 100K that you want to deploy to investing in startups through angel investing. If you do it on a platform like ours, you can spread it around and make many more bets. So your friends, like Alex was mentioning, your friends might not be raising on Wefunder. So it doesn't always work, but there's at least, startups for you to browse. And if there's ones that you're really interested in, that can be one way to just kind of lower the check size and get more shots on goal.
Yeah. Anybody else that wants to?
Other thing as well, about the angel investors, like Alex mentioned that he kind of went informal through network, the people they know, the community he has already. In our practice, we're in touch with high net worth individuals who knock our door, call me, even family friends. They say, look, you're managing all these startups. Is there anyone to invest in? Which one do you recommend? They have money. They are looking for a confident source to tell them this is the right company, the right team to invest. And it's a big burden on people like me, like us, our business, to recommend someone, because you cannot give investment advice, right? But there are people with money, those angel investors, individuals, high net worth investors. They just want to trust a company. And if as a founder, as an entrepreneur, if you have a network of people around you who know your business, who get visibility to your business, see how hard you're working, how great team you're building, how you really getting results, then they would be your spokespersons, spokespeople recommending you to those angel investors. Trust is an important thing when it comes to the angel investors. That's what I noticed.
Awesome. And now that we all know each other really well and we have different backgrounds, let's create an open discussion. If there's anybody that has a question about something.
Yeah, I have
Jonny?
a question for Chris, actually. I'm just pretty curious, like how the market over the last year, like I would imagine Founderpath might be counter-cyclical, like as VC is like much harder to raise, like founders looking for alternative options. But I imagine maybe it's harder to like get debt financing when there's probably pressure on startups like revenue trajectories as well. I'm just curious how you guys have been impacted by the market.
Yeah, no, it's a great question and good insight. I think your instincts are correct. So I think we're in a magical moment. We have simultaneously two things happening, in my opinion. One, awareness around venture, non-dilutive capital and revenue-based financing is just increasing. Like I think many founders don't even know it's an option, to be honest. It's still very nascent as an industry. Same thing with your world. I think it's probably ahead of us a bit, but it's gaining in popularity and awareness, and so that's happening. In conjunction, the market, the VC market, have been essentially closed. Very few companies are getting funded, and people are getting funded, but that has driven
AI
those founders,
companies.
To look for alternatives. And so I think it's been helping. So it's I would consider them both tailwinds. Now you have the Fed increasing rates, and so I think that the opposite side is that rates are getting more expensive, and so it's a little more expensive than it was a few months back. And so there's that constant pool of finding the right price and making sure that it's palatable. but overall, it's been tailwind.
Please, Alex, you had a question before, so I'll let you.
Yeah. Okay. I will let Cenk first.
Okay, thank you. One of the things I see my clients is we're specialized in non-US founders, and they have companies and businesses in their local countries. Like Horst mentioned, is pan-Europe, wants to expand to US. These companies, these startups has business in Romania, in Europe, in Asia, but they have companies in the US, they want to expand. Their businesses in these countries have steady ARRs, MRRs, and they're growing. They're setting them, but for their US business, they want to get funding, leveraging the entities in other countries. And they're struggling because US business is starting, they cannot get revenue-based funding, but other countries are not as open as US when it comes to getting the fundings. In this global world, how can we help them get all those legal entities and their revenue streams in different countries be seen as a bucket and they get funding from that bucket? Any ideas?
Thomas.
Can you just go over that question again, just in like slightly simpler terms? Like what's the
Simpler terms.
direct question?
A company, a US company, which is newly set up to expand in the US, but has subsidiaries in different European countries and Asian countries. And those subsidiaries are making money, nice ARRs and growth. And they want to get funding to their US company, leveraging the ARRs, the revenue streams in their European companies.
Yeah, I mean, I think in general, you can't go to a bank. Bank's not going to be particularly helpful. You might be able to get a bank account, but you're not going to get anything beyond that. You might struggle, and Chris, correct me if I'm wrong, with a company like Founderpath, because you don't have that US existing revenue yet. I mean, the most obvious way to do it is fund it from your European company, so borrow money in Europe and transfer it to the US. I'd say the vast majority of clients we work with don't necessarily care where a business is based, as long as you can kind of follow the money and follow where the customers are. So if you have we work with lots and lots of clients who have businesses based outside of the US, but they have a US entity. So shouldn't really be a problem from that perspective. So I guess the short answer is it shouldn't really matter as long as your European company is doing well, but you can't necessarily rely on the most traditional form of financing, i.e. going to a bank, because they're not gonna help you. But I think on this panel, at least, we have a pretty diverse mix of people from lots of different countries and lots of different locations. And I think most of us have done business in the US without necessarily being physically present in the US. So while I'm currently sat in New York, I built the business for most of my life sat in London. It never necessarily affected me doing business in the US.
Okay. Horst, I know you have a question, but please rejoin again so we can record you.
So I also have a question for Jonny.
Please.
So Jonny, we are currently raising, but I use only our network. We have a big community, so it's very easily for us to raise capital. But how can I manage the discussion with our investors if we will use also Wefunder? For example, we will raise around 12 people right now. If we will use Wefunder and we will have 500 investors, how we will have the communication with them? How to keep these people informed about our activity and so on?
Yeah, great question. So I think the expectations around information rights, both in the contract, are quite different with a community round typically. So your Wefunder investors, for example, don't have the same information rights that a VC has or an angel might have. And then in terms of more practically, actually, conversations, I think the kind of pattern and the paradigm that founders typically want to be in is kind of pushing updates one way. Even that you're under no obligation to do. We think it's good. Obviously, we love it. if founders are updating investors on how the business is going. More importantly, going back to what I was saying earlier, like you should probably only do Wefunder, especially if you don't really need the money. Like you can raise money in other places. You should only do a community round if you see value in recruiting this army of ambassadors, right? And if you see value in that, then it probably makes sense for you to keep them engaged, right? And so maybe it's like a quarterly email update. Maybe it doesn't have the same sensitive information that you might send to VCs or to your board or whatever. But at least you're kind of engaging and keeping your investors up to date with new product releases or how they can help you, and ask of how they can help you. And I think, honestly, like it's not too much of a lift. Like sometimes you have people that reply to that and want to contribute ideas. And if that does get too much, then I've seen one founder actually invested in his campaign early on, and he sent an email to all of his WeFunder investors saying, hey, I love reading your questions and comments and feedback. Please keep sending it. I'm very busy trying to run the company and make you guys a return on your investment. So I don't have time to reply to all of them. So I think just kind of setting those expectations is very kind of understandable, reasonable.
Thank you so much.
Please, Horst.
I'm not sure. Can you see me again? I already see my browser is blocking as a normal Chrome. Should normally work. Yeah, maybe a little bit. We had also discussion about angel investments. I'm also acting as angels. My pick is either I invest in a startup, normally early stage, or seed or pre-seed even, where I see some synergies what I'm doing anyway. So I'm normally investing in something I have no connection points with. And a second, otherwise, if I would do that in a more bigger fashion, I would no longer be operative in a startup, because then I would say I just cannot afford to have 20 plus investments following up and do my normal job, so to speak. I don't see that, and then I would be probably go a little bit. I think Jonny was also saying that, or no, Chris was saying that, more a portfolio strategy. So instead of trying to do the cherry picking and hopefully be right, probably go more with a fund or another vehicle to which I like, or where I like let's say the philosophy, how they invest, and then go wide, and hope maybe in average it works out the way I want to. Because otherwise, if you have not enough tickets in the game, the probability that you just lose is quite high, just by statistics, so to speak. Yeah, there's enough books about it, why you want to have a portfolio and why you want to have a big portfolio if you do investment. What I see now from all my other startup friends, they are quite in a pinch, because if they have done especially financing rounds last year or 1.5 years ago, they are now in the situation they would have to do a down round. So pretty much all the investors telling them, please extend your runway, please extend the runway or do some cost cutting, or go from cash flow negative to at least cash flow neutral somehow. Yeah, so pretty dire situation in that way. So we had an interesting situation. Normally you're quite happy if you have a very good evaluation, pre-money or post-money evaluation of your startup, but maybe they overpitched a bit or the situation was just too seducing, that they are now in the problem. They are kind of a victim of their own success of the evaluation of the previous round, which I haven't personally not seen before, at least not to that extent. Interesting learning. Even if you could maybe pitch more, don't always do it, because you put the bar very high. And what I also would say, that the general situation is quite interesting, because since now some startups are actually closing down, the climate is different. Let's say 1 or 2 years ago, everybody wanted to go to a startup because that's the way to go. And now I have sometimes, a startup, who knows if you're still around the corner in 6 months. at least in the German-speaking market, a little different vibe, I would call it, or tension. So people also know how long is your runway and how is it doing. So the questions are starting to change, at least in my environment.
I think just to build on that, I think one thing that's really, really interesting with what we're all kind of touching on, right? Like Sebastian was saying, he initially bootstrapped. Thomas was saying sometimes like VCs can impede kind of control and like make kind of follow on M&A like harder. Obviously, with what Chris is doing, with what we're doing, like it feels to me like we're at a pretty interesting moment where there's like a real kind of almost like rejection of like the VC paradigm that's been so dominant and like so growing so quickly over the last, I guess, probably 13 years or so bull run. Just kind of curious, do you guys think that's like a temporary, like a temporary kind of pause of that paradigm? Or do you think this is like, it probably feels just like it did in 2008 or 2001? Or do you feel like this is maybe a more, our alternative routes like a revenue-based financing, here to stay, and the kind of VC like hegemony is forevermore going to be somewhat, lessened?
I think VCs are kind of seeing that the investments that they make, those companies, are not that agile to convert. They're probably going to be start checking different things, how quickly they can cut costs, how they can navigate through uncertainty. They'll be more cautious. My projection is, yes, the VC's investments will not pick up that quickly, will not go back that high. It will start, but that will be more selective. That's the way I see. So the platforms like Wefunder and Founderpath will have a higher share of the source of funding for startups who started to generate revenue. And if the interest rates will start to decline at some point, and at that point, investors will not have other alternatives, and that's when they will come back, but will be more selective. That's my opinion.
And Sebastian, you have an opinion about it?
Thanks. And Johnny, I think that's a really good question, but I think to answer that one, we need to answer the question about will there still be industries that need disruption? Because as long as that's the case, then you still need VC funding, and there's still a place in the world for that. As in, if for revenue-based financing, you need to have a product and you need to have clients and you need to have revenue. But there are a lot of cases where to get to a point where you have a product, or to get to a point where that's the case, you need that VC backing. Of course, you could do it with angel funding if you have enough angel funding. And so again, depends on how big the industry is, of how big the product is. And those are, again, areas where VCs, that's the place in the market for VC. But I have also say that being a VC in the past years, it's super difficult given that, again, interest rates going high, pressure on startups to get to those outcomes is a lot higher. So again, it's a complicated life now to be a VC.
Maybe I'm probably again not a video or recorded, but my remark is I think also VC is not really equals VC. For example, in US, to some degree, yeah, you really take a risk. If I see, for example, a lot of VC funding in Germany, they already want to have a validated product market fit. They already want to see they already want to see the traction, so to speak. So kind of the VC in Germany already want to have ticks all the boxes. It says potentially no risk, really, just growth. Yeah. So that, let's say, seed an early stage that somebody say, okay, we are not fully know how the product will look like or how the market will react, or maybe we even have to do some evangelization. Why do we need that? Yeah, I would not go to Germany in most cases anyway, because the risk appetite is not the same. So VC money is not equals VC money. And if you have also now with your LPs for VC, you are careful to do capital calls, because do you really want to do that in the current situation? And second, you have to compete with a, let's say, treasury bond from the US, which is performing, let's say, 5%. Yeah, that is something so to still considered zero risk in comparison. Yeah, so I think I agree with disruptive and high risk, true, but that also means the VC would be willing to take disruptive and high risk in the first place. Yeah.
Sebastian?
Yeah, I was just going to say that I think that's one of the first lessons in business school, right? Is that if you want high returns, you need to take high risk. And that's just like how life works. The thing is that what I've noticed is that a lot of people that go into VC, they're coming from private equity, and private equity works like the same way you were saying, Horst. It's like, it's the numbers super clear. I invest so much, I get so much. I don't want crazy 1000x return. I want 10x, increments like growth per year, and that's how PE works. But you can't apply the same logic to potentially VC-backed startups where you take a super high risk, but you get a chance to be a market leader or you get a chance to create a new industry. So it's a totally different ballgame, I think, between the VC-backed startups and private equity-backed companies. And I'm saying companies because, again, you're already like at a different scale of operations when you get to be at that stage.
Sebastian, based on your experience, I have a question. Last month, I was in a conference in Las Vegas with AICPA, CPA Association. It was about accounting firms, but the PEs and VCs, and there are some mergers and acquisitions happen. And one of the key themes was that the valuations are moving from revenue multipliers to EBITDA multipliers. Now, the investors are more focusing on the, how should I say, the financial sustainability of the business rather than the revenue growth or revenue multipliers. So a healthy financial algorithm, money making, controlling the cash flow, at least being neutral or positive, is a big multiplier impact nowadays. Do you see those trends?
Yes, absolutely. And if like when we raised, the situation economically was already not super bright. I think we were one of the last startups, like trend of startups to raise, and then the market really crashed fully. But when we raised because of two reasons. One was that we had high growth in terms of MRR, so MRR was going up really fast. And the second thing investors really looked at, and they were really like verifying everything, was gross margin. Understanding that we have unit economics that can scale and work. So basically, the assumption was that, of course, CAC will increase, but even if we increase CAC to be aggressive, will we still have unit economics to be profitable? And that was something that we already judged against for them to feel comfortable to invest. Because basically what happened, again, you might know better, but as long as the multipliers on the stock market went down, then they need to adapt and make sure that what companies they bring to that level of being IPO material, they will get enough return for their investments in the new economic situation.
The focus is growing profitably.
Exactly.
Additional revenues bringing additional margin and health. Okay.
Guys, I have a question. It might have been lost in translation, but what is this strange EBITDA concept of which Cenk talks? I work in early stage startups. I've never heard of this concept of profit before. Just kidding.
But that's what I was saying. If you want to see EBITDA or profit, but I think what Sebastian is saying is, I had similar discussions. Could you make your company anytime more or less profitable? So if you, for example, say we are not as aggressive growing, then we would be already profitable. And that is your gross margin or unit or economics pretty much telling you how fast you could go actually from high growth to sustainable mode, so to speak. Yeah. But still, if you're already on such a stage in the business, it's already a kind of a luxury position to be.
It is, yeah.
That's worrying for the startups. What Jonny, you said, and Horst, what you're elaborating. But that's interestingly the trend. That's worrying for the startups when it comes to getting investors, rather than just the growth rates, the revenue multipliers, and as such, now a healthy algorithm, profitability, healthy margins are coming more and more important. I think that is the message. You're totally right. I mean, a startup in early stages, how can it be profitable? It's cash negative. But how is the algorithm working? Is it going to generate money in 6 months or 9 months? Is it going to be profitable? And as such, that's the trend moving forward, a bit less risky trend.
Let's take one more subject and then close
I
it.
would have to have one more question. Do you see a new player coming into the space? I mean, at least in Europe, you're discussing, for example, European Investment Fund for startups, that you maybe have even a new player into the game coming, which was not so active until now.
You mean an investor?
No, I mean government funds.
Ah.
I mean European funds going into the, or try to get into the space. Imagine if you have, for example, a pension fund which can invest only 2% of the pension funds in, let's say, kind of startups. Yeah, or 5% or something. That would be already be a tremendous amount of money, where they potentially could make some profit out of it, because they normally can only go in whatever AA or A investments. Yeah. So do you see also some new players coming into the game, maybe to say, hey, it's not only a VC fund, it's maybe even a government fund? I know a little bit from Norway, for example, but they are normally not going so early stage. Do you see also some new players coming into the game? Yeah, I mean, it's also, I just see in the moment the discussions about it, but not yet it's happening. That's why I was curious.
Governments, they even, most of them slowed down their incentives that they're giving to their startups in their own countries. The way probably that will happen, more governmental funding going into startups, is when government starts to build surplus funds. So pension funds is not a surplus, it's a saving account that has to be invested. But to your point, they have restrictions. The government funds probably will come into play, like the Middle East. Middle East has extra funds all across, thanks to high oil prices previously. They're investing left, right, and center everywhere. But that's not the case for Europe or US yet, that they have all these excess funds to invest a bit more boldly, let's say.
Okay, I guess that was it. Thank you all so much for joining. You did fantastic. This was the first roundtable, and it will definitely stay in history. I'm super grateful for you joining.
100%, or not open rate, but how you call it. So we invite 6 people join. Thank you so much, guys.
We're super grateful. Thank you for joining.
Thank you.
Thank
Super
you.
fun
Thank you very
conversation.
much.